covered by the G20 debt schemes, the Debt Service Suspension Initiative, or the common frameworks. Many middle-income countries are using 30 to 70% of all their tax revenue to pay debts during the crisis. The UNDP says this year that 1.1 trillion is due in debt service payments. Just 2.5% of that amount would be enough to vaccinate 2 billion people under the COVAX initiative. Whereas the debt held by low-income countries that are covered by the G20 schemes is relatively small and not systemic. The debt held by the mix is large and quite systemic indeed. On top of COVID, 2020 was tied for the second warmest year on record, with weather-related damages reaching $268 billion across the planet. Many countries, such as small island development states, are suffering from a triple crisis of debt, COVID, and climate change. The service of public debt crowds out room for investments developing countries must plan to achieve a green and equitable recovery. Before COVID-19, the global community recognizes that we needed to mobilize about 2.2% of GDP additionally on an annual basis to 2030 to meet our SDG and Paris climate goals. If you think about all that, the math just doesn't add up. The world economy, especially middle-income countries that need to mobilize the most financing, cannot afford a debt overhang during the most important decade for resource mobilization of our times. What is a clear-eyed look at middle-income country debt levels in the midst of the need for a massive expansionary recovery that puts the world back on track for sustainable and inclusive growth? While a rise in commodity prices and favorable bond markets may provide temporary relief this week, this month, they mask the deeper underlying fact that many MICs will be hamstrung in their attempts to mobilize the resources necessary for a full green and inclusive recovery that puts the world economy back on track and meets its climate and development goals. This roundtable brings together some of the major global thought leaders on these issues. We'll be hearing from them over the next half hour and then engaging with all of you in a constructive conversation at the global level. Our panelists are as follows. We were supposed to be joined by Her Excellency, the Prime Minister and Minister of Finance, Mia Mottley of Barbados. Of course, a position like that makes someone have to run to more important endeavors, and she's been detained. Not detained. She's been moved. She's moved on to these important things, and she'll be represented by Arvinash Prasad, who is her special envoy to the Prime Minister on these issues. We'll also hear from Rakesh Mohan. He's the president of the Center for Social and Economic Progress in India. He was the deputy governor of his country's Reserve Bank. We'll hear from Carmen Reinhardt, vice president and chief economist of the World Bank Group, distinguished professor at Harvard University. Shamshed Akhtar, the newly named chairperson of the Pakistan Stock Exchange. She was also her country's former central bank governor and minister of finance. And finally, Franco Bruni, my fellow co-chair of the International Finance Task Force here at the T20. So why don't we go in that order? We'll start with Mr. Purcell. And those of you in the audience, if you look in the bottom right-hand corner of your Zoom, you'll see a little Q&A button there. Please introduce yourself so we can start to get to know each other on a global level, and then put a little question in the Q&A. And as I said, after our panelists share their initial opening remarks, I will field some questions and go back to this group of people with the questions that you have there. But please do introduce yourself so we can get to know each other in this pretty inhuman Zoom kind of environment. Well, let us start with Mr. Purcell from Barbados.
Thank you very much, Kevin. It's great to be here. Thank you very much for organizing this with your colleagues, and it's wonderful to be with a group of people I know well, Rakesh and yourself and Shamshad and Carmen and Franco. And I'm really keen to hear their thoughts on this important issue. What is the problem we're trying to solve? Because resources are scarce. And so we have we have to have a boundary somewhere, but those countries we support and those countries we are unable to support with scarce resources. Any boundary is going to create some issues, any perimeter. Rakesh, as a financial regulator, will know that policing the boundary and the perimeter, those are difficult decisions always to make. But what is the problem we're trying to solve? And I think it's well illustrated by looking at the 20 countries that had the biggest economic contraction in 2020. So there are 20 countries, biggest economic contraction, led by Libya and Syria, but the other 18 very much related to COVID. Now, these 20 countries are the biggest economic contraction. Only one of them is an IDA borrowing country. Only one. So in all of the facilities that we are developing and focusing on, they're not going to impact the countries that have had the biggest economic contraction. The second, I think, fact, and there are probably 3 or 4 facts that I think illustrate the problem we're trying to solve. The second fact is as partly a function of globalization, which has had a tendency to converge with countries, but cause divergence within countries. About 75% of the world's poor are in non-IDA borrowing countries. 75% of the world's poor are in non-IDA borrowing countries. And as a result of that, probably the biggest amount of people who will be tipped into poverty as a result of COVID and have been straddling the edge and falling into poverty will be in non-IDA borrowing countries. I think the third fact is that there has been a massive fiscal and monetary stimulus. We're all Keynesians now, right? And we've seen a greater monetary expansion than we saw in the first year of the global financial crisis. We've seen a bigger fiscal expansion than we saw in the first couple of years of the global financial crisis. But there's a big divide because almost 90% of that is occurring in developed economies. There are countries, maybe the real fault line here is countries with fiscal and monetary space. They've pulled those levers right to the end, and there are other countries who cannot. So around only 10% of that monetary and fiscal expansion is in countries we consider developing. And so 90% of the response is in a small number of countries. And in the countries that are probably going to have the 90% of the impact in terms of the health problem and in terms of the economic contraction problem, they don't have any fiscal and monetary space. So this is the problem we're trying to solve. And the boundary that we have with IDA eligibility doesn't seem to solve this problem very well. I think that, Kevin, I'm just going to make 3 points about, firstly, how we might deal with the present very briefly, and then a couple ideas about how we might solve this problem. Firstly, we have a longer term issue. We need to rethink and tinker around with the architecture of debt and concessionary debt, yes, but we also have a current problem. And these debts that have been acquired in developing countries are going to create long-lasting impact. Fiscal challenges, inability for countries to continue their social programs, it's going to challenge development. There's some interesting work, Kevin, I remember seeing, which showed that we tend to think of developing countries as being fiscally profligate and getting into problems because of choices that they have made. But a study done by Dr. Damon King in the Caribbean showed that the single biggest impact on public debt to GDP was actually a result of clearing up costs from natural disasters, seen very typically in Jamaica, say. You might remember the horrors of Hurricane Gilbert and Hurricane Ivan and Hurricane David. And they have the single biggest impact on Jamaica's debt to GDP ratios, and the same across the Caribbean. So we need to solve this problem today. And you've seen, Kevin, one of our proposals has been that it's been fantastic that the World Bank and the IMF and others and have moved towards some kind of reallocation of SDRs, a new issuance of SDRs. We've kind of got halfway. We haven't really got a plan of what to do with them. And we're recommending that at least half of existing and unused SDRs be used to swap with the COVID debt that's been acquired in developing countries, so they can be funded with SDR type rates in terms of their interest rates, in terms of not having a fixed maturity. Let me end my comments though with a couple points about the future. If you look at those lists of the countries that have had the the top 20 biggest losers of GDP, they are all of a type. They're very open economies and therefore faced with substantial economic shocks from the rest of the world. And they're countries of very limited absorptive capacity, either because they're small or they have no fiscal and monetary space, because they're maybe because of their development or their size. And I think that we need to consider new ways of thinking about vulnerability that are forward-looking and not backward-looking, that are about wipeout risks. I got parachuted into the Dominica, almost literally, when they had Maria. Maria destroyed 226% of Dominica's GDP. And when I went around trying to help support Dominica, many people thought you couldn't lose more than 100% of GDP, right? They lost 226%, having lost 96% 4 years before and 45% a few years before that. There are countries which have a wipeout risk, and this is increasing because, as you rightly said, of climate change. And they're countries with very limited absorptive capacity. And I think that we need measures of vulnerability that can help us support these countries objectively and goes beyond GDP. My final point would be this. The DSSI, a great initiative, but very, very limited. It's probably going to lead to increased liquidity of around maybe $12 billion. Developing countries are going to be having debt interest payments and redemptions of $1 trillion between end of 2019 and end of 2021. $1 trillion. DSSI covers about $12 billion. We've got a huge scale mismatch. One of the things, my final point, one of the things that we have done in Barbados, partly by accident, was we are now the world's largest issuer of sovereign bonds with natural disaster clauses. With our natural disaster clauses, the minute an objective indication of a natural disaster is hit, we have no debt repayments or interest payments for 2 years. It saves us 7% of GDP. If every country in the world had natural disaster clauses, it would have saved around $1 trillion of liquidity in a developing world. That is the kind of scale we need. I think we can tweak these natural disaster clauses. We can make them NPV neutral, so they're not a bet on whether there's a disaster to come or not. You take your suspension of your payments for 2 years, you tack it on to the end. And we can make that natural disaster clause strippable. So insurance companies who want long-term instruments can actually trade these strips. But the countries would have the ability that if an event happens, they've got 2 years of liquidity. And you know what? Just like putting caps into all of our bonds, it'll probably raise the credit quality of these countries. Because when they're faced with a natural disaster, the big question is, are they going to default? Having these natural disaster clauses and this liquidity will actually improve credit quality and support the borrowers and the lenders. Let me end there and look forward to hearing what the others have to say.
Thank you very much. Very insightful comments, and we'll move on to Rakesh Mohan.
Thank you. Thank you very much, Kevin, for including me in this excellent panel, especially since in some sense I'm not a debt expert like all the others on this panel. So to reflect that, I won't talk much at all about immediate issues with the debt issues for middle income countries, but perhaps medium-term and longer-term issues. Having said that, I think that the excellent comments that Avinash just gave, I would endorse fully, and especially his last suggestion on including disaster clauses in debt contracts. I think that's an excellent suggestion, very practical also, I think. So what I would like to focus on really is the denominator of the debt GDP ratio. Normally we talk about, most of the time we're talking about the numerator. I want to talk about the denominator, because that is missed out in most of these discussions. And also talk a little bit more on the enhancing ability of middle-income countries to service their debt in the longer term. So, but first, just before I do that, just a comment on the source of debt problems that middle-income countries are facing today. There's been amazingly enhanced borrowing since the North Atlantic financial crisis in 2008-9. very well documented in the World Bank's last year's Global Economic Prospects, or there was a separate volume actually issued on debt itself by Ihan Koz and his colleagues from the World Bank. Why did that happen? It's very important to understand this because, of course, very low interest rates since the crisis, unconventional monetary policy, and therefore search for yields by investors in advanced economies. There was huge encouragement given to middle-income countries, whoever could borrow in the markets, by the multilaterals, including the IMF. What that resulted in is much higher private sector share in middle-income borrowing, which, according to whatever the estimates I've seen, is at least 75% of total external borrowing by middle-income countries. So that is a very important point that we didn't seem to learn from the last crisis. We better learn from this, that the multilaterals, including the IMF and the World Bank, should not be encouraging middle-income countries from doing such market borrowing, which they did over the last 10 years. Because various intergovernmental frameworks for debt restructuring don't cover private sector debt at all, or if maybe a little bit, but not really. So there's a real moral hazard in this, because as middle-income countries get into debt problems, the IMF, the multilaterals get into action, and they essentially bail out the private creditors while doing some debt restructuring for the official creditors. Therefore, I think that there has to be, and second, of course, in that, as others suggested in the earlier sessions, that renewed efforts to arrive at a sovereign debt restructuring mechanism, which were discussed at length in the early 2000s, when I used to take part in G20 discussions, although I have to say that I'm not that optimistic about that happening. It would be great if it could. And again, to continue on this point, that IMF and multilateral bank surveillance should discourage such borrowing rather than encouraging. So that's my first point, that really need to look at the sources of the multilateral debt. What is the composition, particularly looking at private sector debt, and therefore, in some sense, helplessness of the international system to actually do much about how middle-income countries can be helped, particularly with private sector debt, which, as far as I understand, as I said, is 75% of the debt. Let me now go to my main point, which is looking at the denominator, that is GDP. What we really need to do at present, which will have a really medium and long-term impact, is really concentrate on a V-shaped recovery. I have to give credit to my colleague, friend, collaborator, Mr. Anup Singh, formerly of the IMF, for saying V-shaped recovery actually for vaccination, not when we think of the V-shaped recovery, V for vaccination. That the best thing today that the G20, the International Community of Nations, the MDBs, the IMF can do is really support the IMF announced program, just was it last week, on a $50 billion program for really vaccinate. The debt problem will be muted most effectively if we're able to engineer a rapid recovery through this process. The US current experience has clearly shown the effectiveness, has demonstrated the effectiveness of this strategy after a very shaky start. So in fact, the US experience in the last 6 months or so demonstrates that you can actually do this quickly if you really put your mind to it. And this has to be a global effort, because if anything is a global public good, it's vaccination. And I want to again repeat that. If anything is a global public good, it's vaccination. And therefore, the $50 billion, which is, talking about $1 trillion of repayments that Avinash mentioned for this year, $50 billion is nothing. And if the world community, the multilaterals can't do this, that is the biggest thing that will help in solving debt issues. And barring any unforeseen accidents, US is now in the opening mode and will record rapid recovery. And also then that also leads me to the bold fiscal stance of the Biden government we can also think of emulating that in middle-income countries with multilateral support. First, of course, for the $50 billion program to accelerate vaccination in low and middle-income countries, 100%, I would say, a little beyond the IMF suggestion, 100% on a grant basis. Obviously, also contributions from the countries themselves to the extent that their budgets can support that. So it's very, to my mind, is very doable if you put our mind to it in a mission mode, and the cost is minuscule with respect to the benefits. This is the costs and benefits are documented in detail by the Gopinath, that is the chief economist of IMF's proposal, along with her colleague Ruchi Ragarwal's paper, because they have really documented minutely each cost in this program and also how it can be financed. I'm saying we should go beyond the financing program to make it a full grant program. There are some of the issues, of course. First, of course, the financing they should come to the advanced economies, the MDBs, and also donations. Again, given the rising number of multi-billionaires, maybe trillionaires even now, that 50 billion is nothing. And the advantage, the benefit you'll get is tremendous. There will be some issues of production of vaccination on the scale, but once again, this is the kind of thing that with concentrated attention, it can be solved. And of course, the implementation is a problem. One can't just brush that away. That you need to have logistics, cold chain, people who actually do the vaccinations and so on. But I think that some of the experience gained in sub-Saharan Africa in the HIV program in the early 2000s does tell us that these things are feasible. Kevin, if I have a minute, can I take another minute?
Go ahead, Rakesh.
Okay, just very quickly. This is kind of motherhood and apple pie. If you do this kind of thing, then we can also do much more in encouraging middle-income countries to have an expanded Keynesian fiscal program in the years to come, and learn from some of the experiences of advanced economies. There has been a lot of talk earlier today on the credit rating agencies, to some extent for the IMF and the MDBs to encourage middle-income countries to forget about the credit rating agencies. And they will themselves see the benefits of expanded investment programs. And investment programs concentrating, number one, in human capital, which means nutrition, primary schooling, and further. Second, on physical infrastructure, or I should say second on education, because we have more than a lost year for so many children, particularly among the poor. Therefore, there has to be an expanded program in that. And third, of course, and nutrition. And finally, of course, physical infrastructure. Again, this will have a huge return to public infrastructure, promote growth. And here I think economists can help, multilaterals can help in actually demonstrating how you get returns for focused fiscal expenditures, even if you have to expand borrowing for that. And finally, what that does need, of course, is in order to have credibility, to have much more credible fiscal frameworks. I won't go into detail of that because I think I've already gone over time.
Thank you very much, Rakesh. Now we'll move to Carmen Reinhardt, Vice President and Chief Economist, World Bank Group.
Thank you, Kevin, for having me. Let me reiterate the title of the panel, Debt Relief for Middle-Income Countries. And so what I am going to talk about is middle-income countries and debt, but debt relief has a specific issue. For example, I think Avinash's point on contracts is very important just for the financial architecture of middle-income countries. So I will focus on three parts. The first one is very, very briefly, I think Avinash raised this issue, why the low-income countries. Let me just say that of the 73 low-income countries that are eligible for the debt service suspension initiative, DSSI, which ends this December, more than half of them are already either in debt distress or at a high risk of imminent debt distress. So it's not a hypothetical about how quickly you're getting there. That's where they are. Middle-income countries, I think that the common framework that the G20 has put together late last year. Basically, DSSI is seen as a temporary cash flow relief. It doesn't solve debt sustainability issues. I think similar principles are going to be applied for the middle income countries as well that need debt restructuring, okay? That need debt restructuring. I am a firm believer that middle income countries need more debt architecture, and I'll come to that in a second. But I do think that, you know, if you look at the common framework, it says we deal with issues on a case-by-case basis, which is necessary because, you know, in some countries, the lion's share of the debt are bonds, Euro bonds. In others, it's bonds issued in domestic currency, and so, you know, versus you know, hard currency. So the nature of the debt and the creditor base, which has changed dramatically in the last decade, is very varied. But I think bottom line, I think the common framework will be extended to cover middle income countries that come up like Ecuador did, or like Argentina did in early 2020. You know, so that's on debt restructuring. On support for middle income countries, I argued that they were the missing hole during all of this. The low income countries had DSSI. The corporates had the Fed or had the ECB. And so if you look at the high yield universe of assets, the only ones left out were the middle income countries. So the problem there is scale. You know, that for an effective facility to be set up to stabilize, in other words, to do what a central bank did for their own corporates, for EMs, you need deep pockets because the stock of outstanding debt is on a different scale than what you have for low income. But I think it's something to start thinking about in the context. We've had the SDR expansion and so on. You know, a central bank-like function that helps deal with liquidity issues that are not solvency issues, that are liquidity issues and stabilization of assets over and beyond, you know, what we saw. Because let's face it, in 2020, the IMF and World Bank and other multilaterals lent as rapidly and as aggressively as ever in their history to try to deal with the liquidity needs of middle income countries. I do think the issue of climate is critical. I do think that rethinking, if anything, that we should take out of past crisis and the current one, is we really need to think about force majeure more seriously, and this incorporates the climate issues into debt contracts. We also have to think about one of the big issues that we're going to be facing that's going to complicate our life going forward with middle income countries and some low income countries like Chad already, which is collateralization of debt. So, you know, right, you know, collateralized debt, you know, really impacts, of course, seniority structure and so on. So I do think, to just break out what I've said, the first part is to deal with debt, unsustainable debt. We'll have the common frame. Whether you're low income or middle income, I think we'll get to something very similar to the common framework. And I'll just conclude by saying something about the problems of that. Okay. The second is we have to think of ways of providing stabilization, a facility for middle-income EMs in times of crises, beyond the lending facilities that have been deployed this time. And number three, we really had to think about contracts and contingency plans and how to design contracts. Because we say a lot about CACs, but CACs, less than half of the stock of current contracts have CACs in them. But what do I want to say? I still have concerns about debt restructuring. The idea that we can solve this architecture, if we look back to the prior debt crises, the average time it took from the beginning of the debt crisis to its conclusion for it to close was about 8 years, which means a very long period to restructure debt. And I'm talking about middle-income countries. The low-income countries, it's even longer, okay? I think we need to and it's an eternal challenge, okay? Because creditors don't want to take haircuts, don't want to take losses. Debtor countries who are hit by insolvency need debt relief. And making those two meet is a major challenge. I know this is going to sound florid and trite, whatever, but it's actually critical. I think transparency is really important. Debt transparency is very important as a first step, as a coordinating device among creditors, because right now the amount of creditor distrust. Private creditors are, don't like what they don't see about Chinese creditors. Chinese creditors don't like what they see about bondholders. Official Paris Club creditors are displeased with everyone. I mean, I'm oversimplifying, but there's real tensions having to do with asymmetric information. So let me stop there. But I think, those three buckets need to be addressed in their own right.
Thank you very much. Shamshed Akhtar, chairperson of the Pakistan Stock Exchange.
Thank you, Kevin. Like everybody, we all owe you a special thanks for getting us all together on this panel. I've really no issue with all the comments. I really have enjoyed listening to all the panelists. We all know that a debt crisis is looming. G20 debt deal falls short on several counts, as I see. Debt service moratorium is limited in coverage of debtors and creditors. Liquidity support is confined to 40 LICs. Agree, very deserving cases. It excludes middle-income countries, and there is no effective mechanism for private sector debt resolution. Admittedly, it's a hard nut to crack for years of crisis that we have faced. This turns it into a systemic problem, and a global systemic response is needed. G20 needs to agree on an ambitious agenda for tackling the magnitude and the severity of the debt crisis. It's not only the stock, but it's also the flow and the way it's growing in middle-income countries at a faster rate than the low-income countries. And providing countries with the fiscal space for sustainable crisis responses is a challenge. The G20, as we have articulated in a forthcoming report, needs to be bold, and they need to act now. Past experience tells us that delaying the response to debt crises leads to worse outcomes and higher costs. And this has been very well documented by Carmen in so much of work that we have seen of her and are full of admiration of her work. Doing too little, too late will be costlier for both debtors and creditors. The G20 common framework for debt treatments will not suffice to tackle the debt problem facing many developing and emerging economies. And maybe my confidence may change if Carmen is going to change things and how she gets it implemented. But at this point, none of us see a hope for that. So what's the fix? Few elements have to be an integral element. One, the G20 common framework should encourage all low and middle income countries whose debt is considered unsustainable to participate in debt restructuring, not wait for them to knock our doors. Second, the framework needs to be extended to middle income countries and allow for comprehensive debt relief oriented around green, inclusive recovery, and the natural disasters. My career has been in Asia Pacific, and I'm sitting in South Asia. We are at the frontier of natural disasters of the worst kind. Third point I'd like to make is that debt diagnosis is critical. The joint IMF and World Bank debt sustainability analysis is very much something we all need. It ought to account for a full range of emerging risks and uncertainties, going beyond macroeconomic risks to climate and sustainability risks, and go beyond assessing short and long-term risks to properly assess debt unsustainability. Long-term has to be factored in beyond the short term. This work, of course, can benefit from the IMF's recently released comprehensive surveillance review that factors in now climate, inequality, and other risks. This would offer a sound basis for estimating spending needs to scale up investment in climate adaptation and mitigation and the Agenda 2030. My fourth point, if a debt sustainability analysis asserts that a country's sovereign debt is of a significant concern, the IMF should make its programs conditional on a restructuring process that includes private creditors. Adequate incentives are needed to ensure that private creditors participate in debt restructuring where needed and bear a fair share of the burden. My fifth point, in this context that I have just made, that Brady-type credit enhancements for new bonds that would be swapped for old debt would facilitate restructuring negotiation. And this is captured very well by work that Kevin is himself involved in with Stephanie Griffith and Uli. To this end, we propose a guarantee facility for green and inclusive recovery, none other than managed by the World Bank. If payments on new bonds are missed, the collateral would be released to the benefit of private creditors, and the missed payment would have to be repaid by the sovereign to the guarantee facility. There are lots of details in it, of course. The IMF and G20 can incentivize commercial participation in debt restructuring by using moral suasion and regulatory tools. My sixth point is that governments participating in debt restructuring should develop their own green and inclusive recovery strategy, or for that matter, the natural disaster scenario that they are facing, and should develop action plans backed by resources and reforms that align their policies and budgets with the 2030 Sustainable Development Agenda and Paris climate agreements. Sustainable finance is needed to back us to catch up the lack of progress that we have had during this COVID period. And poverty regression, the success that we have in reducing the poverty, is itself a testimony of the damage COVID has done to us. The green and inclusive recovery strategy should address vulnerabilities identified in the DSA so as to enhance the resilience of society and economy, and hence also of public finances. So two elements within that. Some portion of restructured repayments should be channeled into a fund for green and inclusive recovery that would be used for government for investment in SDG aligned spending, bonds, or debt climate swaps. The government would be free to decide how to spend the money from this fund as long as it is helping a green and inclusive recovery and contributes to achieving the SDGs. And I speak on this account because I have seen sitting in Pakistan all these massive assistance packages coming from multilaterals that have not been deployed in green recovery at all, or for that matter, climate adaptation and mitigation. So we have lost a massive opportunity, nor have they gone into building up health facilities. So untargeted, quick dispersing assistance from multilaterals, unfortunately, is not going to help the cause of the debt restructuring, or for that matter, green and inclusive recovery. So calling for a green and inclusive recovery strategy plan as an integral element of debt restructuring, along with defining clear targets and performance metrics to enhance debt transparency, as was just mentioned, to strengthening public debt dynamics, its management capacity, to adopt sustainable borrowing practices, and to strengthen domestic resource mobilization. The domestic resource mobilization is weak at a time when we have to settle massive amounts of debt, and rightly so, running into trillion the debt service demands. So to conclude, signs of recovery backed by fiscal and monetary policies and partial return of private capital flows to emerging and developing countries may have emerged, but economic, social, environmental, and debt vulnerabilities remain significant, of course, in different orders and magnitudes across the middle-income countries. In many low and middle-income countries, debt service is impeding crisis responses and development prospects and ability to adapt and respond to climate crisis. Hence, we urge the G20 to rethink debt restructuring strategy and approach, and none other than the IMF and World Bank can help support the G20 in this endeavor. Thank you, Kevin, for inviting me.
Thank you very much, Ms. Akhtar, and we'll end with brief remarks by Franco Bruni. Franco, you're on mute.
Sorry, very briefly, thank you. I will give you a, I will give you an idea of how we are working on these themes, in the Task Force 9 on International Finance of the T20 Italy. Well, we have picked 15 policy briefs that are now under elaboration out of around 50 proposals that we received. And I would say that half of them are relevant for the theme of today, LDC debt and debt overhang and related problems, more or less directly. Many others are related in an indirect manner. Just to mention one aspect that hasn't been mentioned by anybody, it's the problem of global monetary policy that obviously could move in a direction that could be a disaster for the debt problem. We do have papers, a couple of papers on coordinating monetary policies and trying to incorporate in the decisions the interest of the indebted countries. They are currently under revision, these papers, and will be ready for June 20 to be circulated for comments and proposed to the G20. Let me go through a little few of the conclusions of the proposals of some of these briefs, at least of the first version of these briefs, because they are under revision, as I said. Well, obviously, the global financial safety net is one of the main topics. And here are some of the proposed conclusions. To foster global financial stability and sustainable growth, the global financial safety net should be resettled. The dual IMF accounting, regular and SDR accounts, should be eliminated. The possibility of increasing the share of developing countries in the allocation should be discussed. The global financial safety net should also be aligned with the Sustainable Development Goals and the Paris Climate Agreement. Regional financial arrangements should further optimize the lending toolkits and funding policies so that they complement those of the IMF. The IMF should develop a multilateral swap mechanism that scales up the capacity of swap networks that are already in operation across the global financial system. The IMF success limits and surcharge policy should be reformed because they affect, in particular, middle-income countries and should be suspended or eliminated to support their recovery. A World Recovery Fund, as some of our briefs are imagining new arrangements, new institutions in a way, or institutional arrangement to cope with these issues. For instance, a World Recovery Fund that could be created to allow emerging countries to swap existing debt for new debt and/or to issue new debt under improved market conditions with an underlying project as collateral. This is an interesting complement to any financial arrangements directing resources in a globally agreed direction. To involve the private sector and allow for an orderly restructuring in the event of a wave of sovereign debt crisis, a central credit facility, this is another of the imagined and proposed arrangements, could be created to implement a debt standstill, which would free significant resources. In the briefs, obviously, all these ideas are elaborated in a more precise way with technical details. And there are also proposals that belong more to the legal order. Particularly, there are proposals on how to deal with the legal air cover that should be introduced to temporarily protect countries against lawsuits in the form of either a United Nations Security Council immunity shield or an executive order by the US President or by the UK Parliament, etc., etc. So you see, several ideas. I could go on with the list. We are now trying to discuss them in workshops of various sorts, and there are reviewers that are writing referees. The authors are revising the whole thing. We hope to come out with a sort of a consistent set of ideas to be conveyed to the G20 in the final document of the T20 that will be handed to the G20 by the Prime Minister of Italy. Thank you.
Thank you, Franco, and thanks to all the panelists. Well, given how great all of you folks are, I wouldn't expect anything less than some real concrete proposals. I heard at least 6 of them, expanding the G20 common framework beyond just low-income countries to middle-income countries that are under distress, a deeper facility that's swap-like that countries who are facing insolvency issues can go to. Better debt diagnoses for the debt sustainability analyses, the credit enhancement facilities for new bonds for green and inclusive recovery, state contingent instruments, a fund for recovery, and as Franco noted, a lot of the different researchers and think tanks from around the world that are engaged with the T20 have also proposed many of the similar things that you folks just did, specifically a guarantee facility and some of these other things. We only have 5 minutes. Let me try to, I'm going to ask each of you to sort of give a 1 or 2 minute lightning concluding remark, but give me a second to sort of try to mop up some of the questions that are in the Q&A here that you can think about as you make your final remarks. One of them was to Carmen Reinhardt, where somebody asked, well, what makes you so sure that the G20 will expand the common framework to middle income countries? Other questions, Paul Steele from the International Institute for Environment Development wonders to what extent these credit enhancement facilities or other ways might be useful to get the private sector to the table in certain restructurings. Lots of support for incorporating climate change and and the real resource mobilization needs into DSAs. There's so many questions here, but those are some of the core ones that keep coming up. So let's go in the order that you folks made your initial presentations, starting with Mr. Prasad from Barbados.
Thanks, Kevin. I really just want to make 2 observations. I very much support and agree with much of what we've heard. Let me add 2, if you like, dynamic elements. And I think Carmen hinted at this. We have a dynamic here where we have a differential pace of recovery. You talked about this as well. And it is likely that the countries with fiscal and monetary space recover first, and that they respond to their domestic challenges, perhaps rising price pressures, and as Rakesh worried about, tightening monetary policy at this time before we have swapped the COVID debt into something more sustainable, does potentially trigger a significant emerging market debt crisis. The last emerging market debt crisis, emerging markets were actually a very tiny part of global debt. They're a much more significant part today, so it could be very significant. The second thing, and many mention it, climate change. And climate change adds a dynamic, because when we think about vulnerability, all the measures we're using are looking back in the past vulnerabilities. We are standing on the foothills of the most mountainous thing ahead of us. And I think we need more forward-looking ideas. Now, the campaigners on climate change have tended to push the idea that we're all in this together, and we are in the long run. But there's actually a very differential impact in climate change today. There is a front line of climate change between the tropics of Cancer and Capricorn. These are countries having the most formidable increases in temperature, the most formidable increases in sea level, existentialist kind of risks. We need to identify these countries on the front line of climate change, a swathe of Africa, Pacific, Caribbean, the Americas, between tropics of Cancer and Capricorn, and we need to help them create the resilience they need. These are uninsurable events, rising impacts of a rising correlation, rising frequency. We need to support building greater resilience of buildings, resilience of livelihoods, resilience of individuals, and we need to target this front line against climate change.
Thank you very much. Rakesh.
I would just reiterate what I said earlier. One, that the middle income country debt, 75% of being private, we don't really have current mechanisms to do very much with it in a hurry. In a hurry meaning the next couple of years. Yes, of course, I support all the measures that are being suggested for dealing with that in the medium term, but it's not going to happen within the next 2 years. Therefore, my emphasis on really promoting the economic recovery of GDP, overall economic recovery, hence the GDP. And that is what will make debt sustainable for middle income countries. And the key to it is actually vaccination, so that COVID goes away in 12 months rather than 36 months. What I didn't mention is that this will be continuing, because COVID is not going to go away. You will need booster shots for everyone in the world almost every year. So this is not just something for next 12 months. It's sort of like climate change that Avinash has so eloquently pointed out. And I do think that this requires that much more focus while we think of debt sustainability, essentially focusing on the denominator, that is GDP. Faster the GDP recovery, the more debt sustainable countries become. And then I leave out the other thing that I was going to talk about, which is to do with strengthening countries' fiscal positions. For too long, we've been cutting taxes. And there's a welcome development from the G7, from the Biden government, of putting a floor on corporate taxes. Otherwise, we had a race to the bottom, because we will not have debt sustainability without fiscal strengthening in middle-income countries.
Thank you very much. Carmen Reinhardt.
So why I talked about the common framework being expanded. Let's be very clear about what the common framework does or does not do. The common framework does not deliver any new silver bullets on the debt restructuring front. In effect, it's pretty standard stuff. What's a new element? The new element is that non-Paris Club creditors, notably China, which is the largest official lender, bigger than the rest of the Paris Club combined, is a member. And so why do I say I think that the common framework will be expanded? Is basically saying we have a new Paris Club in town. It's under the guise of the G20 and the common framework, and they will be involved in future debt restructures. It's not that the common framework is offering any. As a matter of fact, my comments indicated that the length of time it has taken in the past to restructure debt, that's something that isn't at the moment overcome by the common framework. One point that listening to both Shamshad and Avinash on debt and climate, I think that's a much larger agenda. I think that's going to be critical. This is not in the context of countries that have debt problems. Okay, this is in the context of normal financing. That the climate dimension, both in terms of how the contracts are written, but also the huge appetite from the private sector. That there is a trend towards more socially, more social investment. And part of socially conscious investment is indeed about climate. So I do think there's going to be a lot more green debt out there that will be part of the financial architecture. And I think that's a new asset class. It has direct bearing for emerging markets because I think it will open up a new way of financing. The only thing, Shamshad, that you said that I disagreed with, I have to say, is that moral suasion may work on the private sector. I don't think so. It does not. The private sector involvement is always usually a long and painful process. When you actually have natural disasters in a single country, they come together much quicker than the rest of the experiences in debt restructuring that we've seen, in which it takes a long time for the private sector to take substantive haircuts, which is why so often we see countries like Brazil in the 1980s had 6 different restructurings. Poland has 8. The Democratic Republic of Congo had 7 repeated restructurings because, of lack of write-offs. So I think we're in for a long haul, notwithstanding all our collective ideas on debt restructuring issues. Let me stop there.
Clear-eyed. Shamshad.
Okay, very encouraged listening to Carmen, that at least she agrees with everything else, but not the moral suasion. I fully agree with her. I didn't succeed as a central bank governor to use my moral suasion on the private bankers. So I do know what she's relating to. let me say that, of course, I understand that common framework will not help us achieve anything. The point that we are making is that we need to be more inclusive in the common framework, because as I understand, it's not bringing in a holistic manner all the debtors, particularly that are very indebted. So that's one point. And second is that nobody is looking for a silver bullet or a solution that will overnight change this. But at least we need to invest in our debt restructuring approaches and modalities going forward. Now, there is, of course, this green and inclusive recovery fund or a strategy that I have been advocating with my colleagues, which I think is a great idea, rather than the money that is going to be given by multilaterals or others is deployed in non-development expenditure. So I do advocate very much that we stop doing policy-based operations at the level of MDBs. I have been myself delivering those during my career at the World Bank, but I do think that what is needed is investments in hardcore areas. So the big point that I'd like to make is that we have to think, and I won't say out of box, but we have to really think on how can we deploy more and more funding in stuff like the climate debt swaps. And I can share with you what's happening in Pakistan. We have a very high level of debt, and as I pointed out, the estimation of the debt is a very complex process, and this is written all over in the World Bank and IMF, and the debt sustainability analysis are not accounting for all types and not measuring the debt effectively. I can tell you in all the documents that I have read, Pakistan has a debt GDP ratio of 70%. Go back to the books and see what is the contingent liability. So we have to be very inclusive of putting in all the debt that's out there for us to understand how serious the magnitude of the indebtedness is and how it's going to impede our ability to be able to achieve real development or fight the next looming crisis, which is really the climate crisis. And I can tell you, I am sitting in Pakistan, and Pakistan has faced its worst heat wave last year, and we are gearing up for it to get worse. We have had a very bad flooding monsoon, and we are going to have yet another one. How are we going to meet these expenses with the debt burden that we carry? Of course, we count on private sector and for multilaterals or G20 to encourage a fair burden sharing of the debt. I'll stop here.
Thank you very much, Shamshed. Any closing remarks for you, Franco?
Well, I think that this webinar and the preceding one, the closed door one, has emphasized the importance of middle-income countries in the debt problem. But in a way, we have also seen the limits of this classification, this definition. Countries are different, and the label middle-income countries is not really effective in many ways. But let me just put the question in general, the issue of the bargaining powers of these countries. I mean, given that we have established that there is a group of countries that should be better defined, that needs more attention by the international financial community, that hasn't been offered the same attention as the smaller and less developed countries. Well, they should put together their bargaining power, organize themselves in order to get more attention by the G20. I hope that this happens, and obviously we can help to some extent to send the message.
Thank you. I'm sorry that we all went over a little bit in time here, but I really want to thank all of our panelists and the over 200 attendees that attended from all over the planet, showing that this is an important issue that needs to be addressed. Like Carmen and everyone else on this, these issues cannot be solved overnight, but as Rakesh said, people are dying right now, and that we need to take this crisis as a moment to learn from the past and to accelerate towards a new future. I want to thank everyone for coming on behalf of the T20 International Finance Task Force that I co-chair with Franco Bruni and others, and the co-sponsors that we had for this morning's event, the Institute for Social and Economic Research at the University of Indonesia, the L20, the Center for Finance and Development at the Graduate Institute for Geneva, the G24, the Intergovernmental Group on 24, the Center for Social and Economic Progress, Greco Economic Associates, the Global Development Policy Center that I direct, and ISPI, the Italian Institute for International and Political Studies. Thank you everyone for coming. Let's continue to watch and discuss these issues at a global level and look to turn ideas into action. Thank you so much.
Thank you.
Bye.
Thank you.